Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, August 19th, and we'll see how things look for Wednesday, August 20th. Well, had a little bit more of a down day than what we've seen recently. Monday was a real comatose day, which lacked pretty much any kind of conviction. Well, we're still dealing with this overhead resistance, and we can't seem to get above it. We start off pretty good, and then things, at least in Tuesday's session, started to deteriorate, and we're seeing the market turning more defensive. Now, we've been watching for this since about the middle of July, where we saw pullbacks in 2023 and 2024. Now we're into the middle of August. Are we starting to see that? Now, there's some apprehension with the markets ahead of Jerome Powell's speech on Friday at Jackson Hole. That really spooked the markets out a couple of years ago, back in 2022, 3 years ago. Is it going to have that same kind of an impact now? There's a lot of different dynamics in play. The market's been pretty positive, had a good summer so far, but we're seeing this general shift from growth over to value, which means the market's getting more defensive. Not necessarily seeing it all the time. We actually saw growth improve a little bit on Monday, but we see pockets here and there. So we just want to keep an eye on things, see if the market is looking more defensive. Doesn't mean we're turning negative. We're still positive on all time frames. We haven't even come back down to the 20 period moving average yet, but we'll be watching that to see if that provides some kind of support. All right, so right at the open, we had a lower open, but then we saw the buy the dippers come in, and that's what we've been seeing quite a bit lately. Not every day, but any kind of weakness, they come in, they try to buy. At least the first part of the day looked like a day trader's paradise where you can just come in and get small little profits. But we found support at S1. Now, the pivot points were pretty close to each other because Monday's session was so narrow as far as the open, high, low, close. And the pivot points for Tuesday are calculated on what happened based on what happened on Monday. So we got down to S1 at 64.39. Okay. Then we rebounded. Looked like, okay, maybe things are going to turn a little bit more positive. We got above the daily pivot at 64.47. So we're dealing with that 64.50 level. And we got above the unchanged level. Then we started to reverse. We declined back down below the unchanged level, the daily pivot, S1, S2, which was at 64.30. Then we got down to S3, which needed to be calculated because I had to break out the old pivot point calculator. We got down to 64.12. And all this really happened not too long after the open. I tend to break the market down into two halves. The open, which can often go until about lunchtime, Eastern time, and then the afternoon. And it's usually in the afternoon when the smart money comes in and either buys or sells, or maybe they really don't do much of anything. Then, as we started to get later on in the day, we broke down, we found support below S3 and tried to rebound initially. Some buy the dippers tried to come in, but then we declined back down to slightly above the 6400 level. So now we're back to dealing with that again, which we didn't quite hit that, but it is acting as support. It's a round number, it's psychological. The more price deals with that, the more it becomes a technical level. And then we closed slightly below S3, so a little bit up from that level. Now, on a percentage basis, was not that big of a move. It just seems more dramatic because we were higher after the open and then we were lower, and Monday was so minuscule as far as price movement. So it made Tuesday's price action look a little bit more drastic, but we're still below average with volume, which is pretty typical in the summer. We're still positive on all three time frames, short, intermediate, and long term. We'll see if that gets tested. So far, since we broke up out of those lows, coming up out of April, we've been above the 20-day moving average except for one day, and that was back on August 1st when the employment report came out and we broke below that, but we quickly got right back above it when we opened the following Monday. Interest rates fell a little bit there. Doesn't seem to be a real concern right now. We're watching that 4.5% level with the 10-year yield. We've been watching that. It seems like forever because there's this concern about inflation starting to come back into the market. And you can kind of take it back to last week with the PPI. Now, the CPI came out. That looked fine. The market really liked that. Then PPI came out and showed some inflation. And the concern is that going to drift over into the consumer part and be inflation that we feel even more than what we have been feeling? And the market still has yet to get down to that 2% inflation level. It seems to be kind of stuck right around 3%, which is not really what the Fed wants to do there. And we did have, there's going to be some earnings that come out in retail in Wednesday's session. And we're kind of beyond the big part of earnings season right now, but there's still some companies that will come out and report. And there's things going back and forth about, okay, what's going to happen with the Russia-Ukraine war? And there was the big meeting at the White House and different talks going on. There's different things being floated right now. The market's really not paying all that much of attention to that right now, anyway. So the Dow did set another intraday all-time high not too long after the open, but it gave up most of the gains. It was one of the few indexes beyond the NASDAQ, NASDAQ 100, and S&P that ended up closing slightly positive because growth got hit pretty hard in Tuesday's session. So it was up, but it was well off of its highs. Mega caps and tech underperformed. Now, they've been having a pretty good year, so there might be some profits that are starting to come in, profit taking, that folks are deciding to finally do instead of trying to ride this thing higher. But we'll see. We have these days like this where it appears the market's getting more defensive, and then we kind of chop our way back, and growth seems to be coming back after that. And then we have another day like we saw on Tuesday, because some of our charts actually improved on Tuesday. The mega caps and tech didn't do all that well, but some other stocks actually advanced. But since the mega caps have so much of an impact on how the index is calculated, it ended up bringing the S&P down and the NASDAQ and NASDAQ 100. And growth did underperform value. And the S&P appears to be becoming more defensive ahead of Powell's speech on Friday. That's kind of the scenario that we're floating right now. Now, back in 2022, if you were in the markets at that time, that kind of caught the market off guard. The market was going up. We had already had some declines before that, but it appears that we were bouncing up out of that, and the market just thought, okay, well, Powell's going to come out and we're going to like what he says, and we're just going to keep going back up. That's not what happened. And they were caught off guard by his comments. And then we ended up turning and going down after that and went into a more convicted bear market that lasted until October of 2022. So the market's like, okay, we're going to be ready. Now, is this going to be one of those sell the rumor, buy the news kind of a things? What if Powell comes out and the market likes what he says on Friday? And are we going to be able to get some strength back from that? Or is he just going to confirm what the market is already doing, which appears to be getting more defensive? All right, the White House is planning a trilateral meeting between Trump, Putin, and Zelensky in Budapest. Lovely city. Been there. Really nice. But the market didn't pay attention to that. It's like we've heard all this rattling around before, and until there's an actual deal out there that we see, we we might jump the gun when it comes to trade deals and tariffs, which now seems to be lessening. But when it comes to ending this war that seems to be going on and on and on, let's wait and see until something actually gets settled that looks more concrete. Now, on the short term side, we just have stochastics. We pretty much have lost that positive momentum that had been sticking. We saw even on Monday's session, we saw it wearing off a little bit. It never became fully strong even last week. Now, because there are three charts on that stochastics overall chart that I show, those tend to go a little bit slower there. And then intermediate term, the Sean trend meter, which is declining, but it's right on the border between being the initially extreme positive and going back more into a neutral reading. But the context is that it's going down. No change to the overall scenario with the Fed. We'll see if something does change later on in the week when Powell gives his speech. The dollar was up and interest rates were down. We're at 4.3% with the 10-year yield, where we had been at 4.34%. The dollar's back above its 50-day moving average, but still in a pretty significant downtrend nonetheless. Sentiment, it's still positive, but now we're ticking down. We had been at 65, now we ended up coming down to 60. So the context is shifting a little bit more negative there. We're still positive with our trend though. Now the ADX is rolling over a little bit, but it hasn't crossed below its moving average, either on the short or intermediate term chart. And the green line's still above the red line. So we're still positive that way. With the down day, the bias is negative. I'm still keeping the momentum at positive for right now because we, like the advanced decline line, it went up and we saw some of our moving average studies actually go up in Tuesday's session. So until we see more than just one day of this value overtaking growth type of a thing, I'm still going to keep the momentum at positive for the time being. But we look at the pattern on the chart of the bar itself, it's looking a little more vulnerable, not only for the S&P, but also for the NASDAQ and NASDAQ 100. And I'll show you that one there. So we just had housing starts come out, which was up 5.2% month over month. When you annually adjust that, it's 1.428 million, which was more than the 1.311 million. So that came in stronger than expected. Single units were up 2.8% and multi-units were up 9.9%. All right. Building permits declined though. It was down 2.8% month over month. When you adjust that to an annual rate, it was less than expected at 1.354 million. They thought it would come in at 1.390 million. And then single permits were up 0.5%, but multi-units were down 8.2%. All right, so here is a chart just showing a 3-month average of housing starts and building permits. Where you look over the last 3 months, we're actually going up still here with the housing starts, but the building permits are coming down. So we're seeing a little bit of a disconnect there. They're starting to build things, but then getting the permits has been declining now over the last few times we've seen this reported. Then you look at this on an annual basis with the housing starts actually still going up here a little bit. We've been seeing a bit of a rebound here. All right, then Isabel Net. Every Wednesday we get this chart from Real Investment Advice, which is really part of SimpleVisor. I believe they're part of the same organization. Now, when we look at this, and this is longer term, and we're still up into the 88 range. We're at 88.85, which is, we came above this 90 level. Typically, when we get above the 75 level or even the 70 level, that's when we start to become overbought, and we're coming down a little bit from there, but then it bounced back up in the latest reading. So this is still considered overextended in the short term. And equity drawdown risk has picked up recently. This chart is kind of convoluted here, but I would just take away the headline. Just means there's more risk of declines based on this chart, despite the Goldilocks volatility reset. Okay, so volatility's been a little bit more under control. When you look at the VIX and some of the VIX studies that we do, where we saw some warnings was a few weeks ago on August 1st when the volatility risk premium was really high, but we weren't seeing that in the VIX. And this is starting to go back up. And this is just indicating, according to this measurement, that there's more risk in the market currently. Consolidated equity positioning still above zero and going up. So that's still positive as folks are still leaning more towards stocks. That would be more risk on. Central bank gold demand moves in cycles with buying occurring for financial or geopolitical reasons. So here is what we see the reported holdings, which continue to go up. And the cliche for gold is it's a protection against insanity. So when things are really going crazy, people flock over to gold because it's a tangible asset if you actually own the gold itself. And then Goldman Sachs thinks, whoa, we're going to even go up more than that. They're going to be buying a lot more gold because things are going to get worse going forward. Then earnings growth for the S&P 500, we're focusing here on, we're looking now at the second quarter of 2025, where it's still looking pretty healthy. The bottom up consensus here, looking forward, where we do see a drop off, but still it's positive and they still tend to go up moving forward from here. Then use of cash 2020 in 2025, the second quarter year over year change. A lot of money going in for AI, a lot of infrastructure coming in, and that's seen as a vote of confidence for the economy. Really putting money in there. Research and development also seeing a pickup there. Dividends, that's profits that are paid to shareholders with those stocks that do pay dividends. And then buybacks. It's actually gone down a little bit. Now we've seen a lot of announced buybacks, and we see a chart of that ever so often. They may announce it, but do they actually go through with it and actually buy the stock? And according to this, yeah, there's actually negative flows going into that where they see it coming back to even looking forward. Valuations, we see this all the time. We've been overvalued for years. We still continue to be overvalued in the US. We're coming in at 23.2. That's high. I mean, we're well above that 20 level compared to the rest of the world. And bond fund flows by maturity over the last 4 weeks, seeing more money going into long-term bonds. Now, that could end up being positive. If folks are doing that, they might think that, okay, the long-term rate has topped out and it's going to start going down. And so we better buy those bonds now and we can just hold on to them. Even as interest rates dropped, we've already locked in a higher interest rate and a little bit of a drop off in the intermediate term and dropping off in the short term from where it was before. So more money going into what they say the long end of the curve here. And earnings revisions, this still is very high. And I showed this chart recently as well. And where a company, the analysts come out with their projections, and then the stock market reacts according to that. The company comes out periodically and they make their announcement, and they tend to lowball that. And then when they come out with their earnings reports, they look like, oh, we're heroes. We even beat our estimates here. And we're still seeing revisions looking forward, still looking pretty high right here. And that's more positive for the market. Then home prices. This is just showing the takeaway here is all the different indexes that we look at show that home prices are coming down. And then here's another home prices. And this is a little bit misleading on this chart. This going up, you would think house prices are going up. But what's happening is this chart going up means that's how much housing prices are falling. So it kind of goes out counterintuitive there. And then retail versus the professionals here. Retail flows are marching higher. This is money going into ETFs. And a lot of people are still buying into a lot of ETFs. And where you look at this kind of yellowy green line, not yellow, bluish green line here, the professionals, they're not, I mean, they're positive, but they're not really sinking a lot of money into that currently. And then they're actually, let's see, okay, individual investors are in brown. Oh, corporate bonds. Okay, I'm sorry. That's this kind of yellow. Why do I want to say yellow? It's blue, bluish green, where money's actually, excuse me, coming out of the ETFs here. Sometimes I get a little tripped up with these charts because I don't make them. I don't put my own logic into these charts. And I go from chart to chart to chart, and sometimes I kind of get the interpretation a little off here. Then best and worst sectors, looking at the 11 S&P 500 sectors, the spread between the best and worst performing sectors is just 18%. That is low relative to both the index's own history as well as other indexes. So even though we have some areas of the market that have been underperforming, it's not as bad as it has been in the past, according to this one. Then global beats. Now, not just in the US, but we're looking internationally here with how companies are coming out and actually beating their earnings estimates. The US by the most, but all of these, I mean, even Japan, emerging markets, global, Europe, US, we can see here. These are beating what they said they would come out with. All right, here is the chart. So it looked like, oh boy, we're going to have another yawner of the day. We came down to S1 and then we bounced up. We didn't quite get up to R1. And it looked like, all right, we're just going to chop around. Well, then we broke lower. And this was still relatively early in the day where we came down, tried to find some support right around the S2 level, but that wasn't working. Then we fell all the way down to S3, broke below it. Got close to 6,400, but we would get closer to that later. Again, the buy the dippers tried to come in and boost this back up. We got back above S3, then we broke down below it. Didn't quite get down to 6,400 and then bounced up a little bit, but still ended up closing below S3. and we saw it tapering off. And we're down about a quarter of a percent, 8 or 9 hours now before the market opens as I'm recording this. So this pretty much all happened during the cash session on Tuesday. We were looking rather muted going into the open on Tuesday, and then the selling took place during the actual session the market was open. And this is turning a little bit more negative, where value actually went up, and the red line's above the blue line, where value is coming down. That's the blue line. So this is another indication on the intraday chart that value is outperforming growth in the shorter term here. Can this continue? Now, we've been seeing a gradual shift here over the last few trading sessions, the last week or so, where we've been chopping above and below, above and below. Now we're seeing a little bit of a breakout. Is this going to continue? Now, we've seen this before, even back in July, where value was outperforming growth. The red line was above the blue line, but then eventually the blue line came back and retook it for a while. But you can see these periods in here where the red line's going above. Now, the market can still go up when it's doing that, but in a more positive environment, we want to see the blue line above the red line. And this is another thing, the growth to value ratio intraday for the S&P. It started to top out right about here at the beginning of August and has been drifting lower, and it continues to go down even in Tuesday's session. This is also suggesting the market's getting more defensive. And growth was down 1.24%, where value was actually up. And growth was down more for the mid caps, where it was value was up for the mid caps. It was down for the small caps, where it was up for value for the small caps. So clearly a shift over to a more defensive posture with the market. And taking a bit of a hit here with the small cap growth to value ratio, still in an uptrend here, but not really showing any conviction going back to about May. We've been just chopping along sideways overall and actually dropping below the 50-day moving average of mid cap growth to value here. We reclaimed the 50-day moving average on Monday. We saw a slight improvement. Now we're seeing it starting to taper off a little more, even though the bigger picture is that we're still in an uptrend and falling back below the 50-day moving average with S&P growth to value, where we had reclaimed the 50-day and now we're back below it. But longer term, we're still in an uptrend here. If this continues to fall, that's going to continue to suggest the S&P is becoming more defensive. And we saw kind of a big drop off here with this growth to value ratio, where we're coming back down into the rainbow. And discretionary is holding up fairly well with the equal weight discretionary to staples ratio. That's looking a little bit better there. And then I pull this up from time to time. On the top part is a weighted version of discretionary to the S&P, where that came down a little bit, and we've seen a gradual upward move here. Where when we take out Tesla and Amazon, which make up a huge part of the discretionary sector, this ratio is still holding up a little bit better. And now, where we're seeing some weaknesses, tech to utilities. That took a pretty big hit on Tuesday, as did biotech, which is growth, to healthcare, which is more value. That took a bit of a hit here. Didn't see much of a change when we look at hotels to utilities, though. And then value to tech, we're seeing this bouncing back up. This is a reversal of the growth to value type of ratio, where it's been declining overall, but that went up rather significantly here. But is this going to continue? That's what we're going to be watching for. If we just see this as, oh, it just happened for a day or so, or up until Friday after Powell gives his speech, and then we see this ratio coming back down, that would be more positive. So as far as our trend, seeing some weakness here with the green line coming down and the red line going up, but the green line's still above the red line. That's why we're positive. We are rolling over with the ADX, but we haven't dropped below the moving average, at least yet. And it's a very similar thing here with the intermediate term. Green line above the red line, showing some weakness, but still above the moving average. And we were still below average with volume. You can see we were less below average on Tuesday than we were on Monday, but still below average nonetheless. And sentiment, we ticked up. Not a real big spike here with the VIX on a closing basis. We're getting up into the mid 15 range now, where we had dropped down into the 14 range. But we're still below the moving average here with the line chart as well as the bar chart. And this is what we're watching for. And I've been talking about this for the last couple of weeks here with this seasonal chart of the VIX. If it's going up, that usually means stocks are going down. Is it starting to happen now? And seeing a bit of a pickup in volatility here. We're above the moving average with the VIX of the VIX with the bar chart as well as the line chart. And we're still up in this red area. We're not really sure if this means an up move or a down move, but the market is still expecting a move. There's a lot of out of the money options that are being bought, hoping that those options will become either at the money or in the money and can be sold for a profit, according to the skew index. And this is kind of interesting. We were pretty much unchanged with this fear gauge, where we actually declined with this other fear gauge. So, not a lot of confirmation there. And we saw a bit of a pickup with the down day with the equity put call ratio daily chart, but we're still going down with the 5-day chart and the 10-day chart, which is still more positive and seeing a bit of a gyration lately. We started to top out at the end of July with the high beta to low beta ratio. High beta would be Nvidia, Microsoft, Google, Apple. When this is going up, that means those stocks are outperforming. And we've seen a bit of a gyration here at higher levels as it's been chopping around. Well, it took a pretty big hit in Tuesday's session. And then this is the volatility risk premium, where right at the end of July, right before the employment report came out, we saw this really giving us a high reading. It's since declined and it's back down to within its range. And see, we're here, the advanced decline line based on price and volume actually advanced a little bit. And we're actually still above zero and going up with the 10-day advanced decline oscillator. We ticked up with the advanced decline ratio, both in the short and intermediate term. And we're seeing a drop off of the new highs here, and that's causing our 5-day to flatten out a little bit, where the 10-day is actually now starting to go down. But we're not really seeing any expansion of the new lows. It's more of a contraction of the new highs. And this is still hanging on to barely positive in the longer term. We're still slightly above the moving average. That's longer term. But shorter term with the boom indicator, we're now seeing this declining. So short term, we're more negative. Longer term, we still are hanging on to being positive, but showing weakness. And we're back to looking negative again with the Chaikin money flow, and we're back to declining again here even more with the Chaikin oscillator. So in the short term, all three of our smart money indicators are negative. In the longer term, you could still make a case that the accumulation distribution remains positive. No real change here. And we've been seeing this flatlining, both based on the buys and the sells here with the vortex. We're still positive with the green line above the red line, but there's been very little conviction as we entered into August. And we did see an improvement here. This is an apples to oranges comparison. You have the S&P coming down where the NYSE advanced decline line went up. And we're still seeing some improvement here with our advanced decline line studies. We went up with all the indexes, even though the S&P closed lower. And we improved here with those stocks above their 20-period moving average in the S&P on a down day. That could be some of the rest of the S&P that's being purchased now and driving prices higher that way. But because the mega caps underperformed, that ended up dragging the index down. You can see we're looking a little bit vulnerable here. We've been going sideways with price, and then we saw a bit of a drop in Tuesday's session. Is this suggesting that we're going to see more of a decline from here? Because now we've lost this pattern that we were seeing of higher highs and higher lows, then we flattened out. Now, a lot of times what will happen is we'll flatten out, consolidate a little bit, and then break higher. And of course, that could still happen. But for right now, the fact that we're declining here shows that the S&P chart pattern is looking a little more vulnerable. And we did improve with the 50-day moving average, 100-day moving average, and 200-day moving average. So no real damage done there. And we came up to this pivot point here, which is for August, and we kind of just stopped when we got about to this pivot point, and now we're starting to decline. But we're still in an uptrend. The blue line's still above the red line, but we continue to be below average with volume. And we improved with the exponential moving average based on 20, 50, and 200 periods. And declining, but still above the midpoint with the Stochk RSI. Now, it had never gone above this zero point 0.8 level here. That's suggesting that there's good positive short-term momentum. Never got up there with this chart. We did with some other ones, though, like the Williams percent R. It was showing good positive short-term momentum. Now it's dropping down and is no longer extreme, and the context is that this is declining, so it's looking more negative. And we also dropped down with the CCI 14 and the CCI 20 chart. The only thing that's extreme is the stochastics. Now, in the short term, we're not. We're actually looking more negative and no longer extreme with the short term stochastic. declining below the moving average, but still extreme in the intermediate short term, and starting to flatten out here with the long short term stochastic, and just barely above the midpoint with the force index. We're just barely above zero here, but we have dropped below the midpoint with of the measurement here, but the other midpoint is between positive and negative. Seeing a little bit of vulnerability with the short-term trend, we dropped below the green line and the blue line here. If we stay down here, these lines will continue to roll over. And we're going to be watching the 20-period simple and exponential moving averages. We're still above it for right now, so we're still positive in the short term. But if we come down here, are these levels going to hold? This is what I was talking about. We spent one day below the 20-period moving average and then quickly got above it, where we finally broke above it back in April. And then going into May, we've been above the 20-period moving average the whole time, except for that one day. And I wanted to show the rainbow. I usually only show this in the deep dive video over the weekend, but this is still looking positive for right now. Even though we're coming back down here, all the lines are continuing to go up. And this is a 10 through 50 period simple moving average with the rainbow changed to different colors. So it looks kind of cool there. And we're coming into the +1 channel of the standard deviations chart. We got up into the +3, we drifted down into the +2, now we're coming down into the +1. Now, intermediate term, after turning slightly positive with the balance of power, now we're turning back to slightly negative. And we switched over to more of a neutral stance here with the go, no go, with the lighter blue bars. Coming down here from the highest high value, but we're still above the midpoint. Still registering an uptrend here with the Landry light. We're now on day 76 of this uptrend. Still in an uptrend here with the proper order. TTM squeeze turning negative now. Darker blue starting to roll over where it had been looking more positive. Still barely above zero here with the ease of movement. Still positive with the Arun since we're above zero. Even though the buyers are dropping off, the sellers are also dropping off, which is keeping the oscillator down below more positive. And we cross back above zero with the S&P McClellan oscillator. We have a down day with the S&P, and this actually shows some improvement. So we're starting to turn up here based on price, and we're kind of going up here based on volume. Now we improved with the NYSE McClellan oscillator, but we're still slightly negative. So when we look at the summation index, we're going down based on price and volume for the NYSE. And now we're back to negative with the Soylent Trading oscillator. Based on price and volume, they are both declining. We were trying to turn positive here with the PMO, and a lot of our momentum oscillators were starting to improve. But with the down day, now this is starting to drop down below its moving average and drop down below the red line. We're kind of right on top of the moving average here based on price. We never got quite up to the moving average based on volume. But inside, we still saw an improvement with the PMOs rising, actually climbing up above 50. The buy signals increased, and we're seeing a little bit of an improvement with the PMOs that are above zero. So we have a down day, but we're seeing some internal improvement. But those improvements are coming from value areas, not really growth areas of the market. And we are still neutral with the Elder's Impulse system for the S&P, still positive with the parabolic SAR, rolling over a little bit and coming down to its moving average with the slope oscillator, coming back down to the moving average with the MACD. So we had been seeing some improvement here in the short term. Now it's looking a little weaker. We're also showing some weakness in the intermediate term. We never did really turn positive in the long term. The tricks never got above its moving average. The KST was right on top of its moving average, but both of these longer term oscillators are now flatlining. And we're still positive, but slowing down a little bit here with the Copic curve momentum oscillator. And this is the Sean trend meter. I was talking about the context. We were in the dark green area. We came down to the lighter green area. We're right on the border. If we drop down below 80, this would go into the even lighter green area. But the context is that we are declining. And we're still above 50 with the money flow, decline, but above 50 with the ultimate oscillator. And we're still above the moving average with unbalanced volume. We decline, but we're still above 50 with the intermediate and short-term RSI charts. And coming right down to the green line, which is the 10-period simple moving average. So this is still holding for right now. And the lines are still continuing to go up. Intermediate term trends still going up with the red line and the blue line, but if we spend any considerable time below these lines, they are going to roll over. And we'll be watching the 20-period moving average. But in the meantime, all of the moving averages continue to advance higher. And we're not extreme now. We're getting closer to that 20 period moving average as measured by the boom indicator. And we're not far away from the 50 period moving average. And we're still above zero and kind of going sideways with the 200 period moving average steady. But then the bullish percent index improved. So you can see there's some buying going on here. It's just not in growth, at least in Tuesday's session. We're above the moving average, we're above 50, and we are advancing. So this is positive. And we're going up with the NYSE bullish percent index, and we crossed back above 50 even with the NASDAQ 100 bullish percent index. So some subtle under the surface improvements that we saw even though we were down. We came down to the upper end of this 20 period simple moving average of the open high low close. This could be providing some kind of support. We'll see if we're able to bounce up off of that or are we going to start to fall through the little mini rainbow. This is what I was pointing out over the weekend. We seem to get near the 64, 68 level, and now we're having a difficult time getting above that. We might get above it intraday, but we haven't been able to close above that, and that's still counting as overhead resistance. Right now, no major damage done, but the market knows this and it sees this longer term overhead resistance. And I've been really pounding this myself. And right now, we're it's seeming a little more doubtful, at least after Tuesday's session, that we may be able to get above that. Now, things could change. Some really good things could come out as far as news or things that the market decides to react to in a positive way, and we could get above this. But right now, we're not above it. And this is that longer term trend line. We came right up to the underside of this upper trend channel here. And this is about where we started to really slow down. And we're turning a little more negative with the Heikin-Ashi with the black candles. We're positive but pointing down with the Kegi chart. So it's positive with a negative bias to it. But we're still looking positive with the Renko chart and the three-line break chart. Long term, we actually improved a little bit with the 150 and 200 period moving average steady. Positive on all time frames now, even with the decline that we saw across all the different indexes. And we're still positive here in the short and intermediate term with bonds based on price, negative with commodities in the short and intermediate term. And the dollar's now switched to an uptrend. That's because it recaptured its 50-day moving average. It might be a 20 period moving average. My chart's different than what they use to calculate this. It's stock charts. But you notice the three big growth areas, they were the ones that were down. Discretionary, communication, and tech, with tech leading the way lower. The defensive areas, real estate, staples, utilities, if you count that as a defensive area, healthcare, these were the areas that really led. And that's where we saw value outperforming growth. And a lot of red here, where at first we had a BPI cross below 50 with the energy sector, but then it ended up improving later in the day. And then the NASDAQ took a hit below 21.6, 21.5, 4, 3. Then the Dow set the intraday high here, but it didn't close at that level. Awful lot of red with the big boxes here. Over here with the tech sector and communication and discretionary, all of them. And this is why the S&P declined. And we saw an improvement here. Even though the S&P weighted index came down, the equal weight version was actually up on the day. And here's the Dow, where it set another just barely new intraday high here, but closed well off of the high. And the last couple of trading sessions haven't looked really good. Last Friday, we opened at the high and then closed at the low. Saw a really muted day on Monday. Again, we tried to break higher with the Dow only to close below the open. And even though it was up 0.02%. Now, it's still in an uptrend here, and it's still above this R1 pivot point now. It hasn't broken below that support level. We're still positive with the diamonds looking at the Elder's Impulse system. This is looking a little more vulnerable, kind of like what we're seeing with the S&P. The NASDAQ got up to this R1 point, and now it's starting to drop down. It was down 1.46%. We're negative with the NASDAQ with the Elder's Impulse system. Also a little bit more vulnerable. Now we did get a little bit above this R1 pivot point here, but now we're dropping down with the NASDAQ 100. Also going from neutral to negative with the Qs when looking at the Elder's Impulse system. And we had been positive with the momentum for the NASDAQ 100. Now it's back to negative. We're dropping down below the moving average. And we're coming right down to the 20 period moving average with the Qs. So we're already hitting that with the NASDAQ 100 or the triple Qs here. We haven't hit that with the S&P yet. So we want to watch this, see if this ends up providing support, or if we slice through that, that could suggest there's more weakness coming into growth. Still above this long-term trend line with the NASDAQ 100 weekly chart going back to 2009, even though it did decline. Still above both moving averages here with the S&P 600 small caps. So we still might generate a golden cross, and we did generate a golden cross with the Russell 2000 small caps, but just kind of chopping sideways, ended up declining on the day. Neutral with the small caps when looking at the Elder's Impulse system, still kind of going sideways right now. The mid caps were actually up a little bit here and still in an uptrend, still above this pivot point, and still positive with the Elder's Impulse system for the mid caps, even though we closed well off of the high. The Wilshire coming down a little bit. That's another broad market measure and dropping 0.6% here with the total US stock ETF. But in the bigger picture, it's still positive. And we were up a little bit here with the financial sector, still above its 50-day moving average, but it bounced up, but we're still well below the 200-day moving average when we do the ratio between the financial sector and the S&P. And this is where we saw most of the damage. The FANG index, the big stocks, they did decline, but bigger picture, we're still in an uptrend. We have yet to even get back down to the 50-day moving average. So we saw a bit of a spike up here when we look at the staples to tech ratio. That's more defensive. And Apple was down, but not very much. And Amazon was down 1.5%, but still above its 50-day moving average. Microsoft down 1.42%, still above its 50-day moving average. Google was down 0.95%, still in an uptrend. We did decline with Meta over 2%, still above its 50-day moving average. Nvidia down 3.5%, still above its 50-day moving average. So you can see some weakness coming in here, but not an awful lot of technical damage. Tesla, which has been chopping around all over the place, it was down 1.75%, but still above its 200-day moving average. Netflix declined almost 2.5%, back below its 50-day moving average. And this is actually turning more positive. This is home construction to the 3 to 7 year bond ETF. I did the what to watch video over the weekend and I kept this on the negative side. I could have easily put it on the positive side, but we're still coming back above the rainbow. Now, this started to fall apart right at the end of 2024. And then we went into some problems in 2025. Is this suggesting things might be getting a little bit better? Because it's a very interest rate sensitive environment. And if interest rates continue to drop, maybe that'll be more positive for stocks. And we have to be aware of the context. But this is actually showing quite a bit of an improvement with this ratio. And we're also going back up with the staples to S&P ratio. Overall, this still has been declining, but we hit a few times here where we started to chop around and not show as much conviction. But in the latest reading, this is going back up, which means staples are outperforming the S&P and still seeing a pretty strong short-term correlation between US and world stocks, starting to turn back up a little bit with the longer-term correlation. And we're dropping down into the lower 60s now as far as oil. And we're back above the 50-day moving average with the dollar index, but still in a pretty decisive downtrend there. And we declined a little bit with the 10-year yield here, and we were up a little bit here with the 10-year based on price. So seeing some weakness here with the Qs to S&P, which had been holding up quite well. Now we're dropping below the moving average, but the moving average hasn't started to roll over yet. We did see an improvement where discretionary to the S&P, that was under the moving average. Now it's starting to go above the moving average. And for the first time since going back to about May, we're seeing large cap growth underperforming large cap value and dropping below the moving average. Now we want to see follow through with this. If we see a continuation of this, then yeah, the market's going to be getting more defensive. But we have seen days along the way where value really outperformed growth, but it didn't last very long. And starting to drop below the moving average with the large cap growth of value, still below the moving average with the mid caps, and back below the moving average with the small caps. All right, so we're just kind of keeping an eye on what's going to be happening at Jackson Hole. The big deal will be on Friday when Powell gives a speech. We're still positive on all time frames, but we are becoming more defensive. But are we going to see any follow through with that? And we still have yet to get above this overhead resistance, not only for the S&P, but the NASDAQ and NASDAQ 100 as well. And we're going to get the MBA Mortgage Applications Index, and then the FOMC meeting minutes will come out at 2 p.m. Eastern Time. The market will be dissecting those to see if there's any insight they can get from that. And then anything that may develop that the market might react to as far as the Russia-Ukraine peace deal, anything that might come out as far as trade deals or tariffs, and then, of course, anything else that could explode in the meantime. And then we have a pretty big day Thursday, at least a longer list, but the most important thing will be initial claims and continuing claims. And then the only thing happening on Friday will be the speech that Chair Powell ends up giving. So Wednesday, I don't pay attention much to the crude oil inventories, but then the meeting minutes, that's kind of the big thing of the day. Seasonally for August 20th, we're neutral to positive with the Dow, but we're neutral to negative with the S&P. So not much of a real edge either way. We are in the week after options expiration, where we're down 55% of the time and up 45% of the time. And this is where we're tending to see a little bit more drifting lower during post-election years for the S&P on a seasonal basis. We still have yet to be positive in August during a post-election year. This also shows the post-election year weakness, as does this, that could carry over into September and possibly even into October. So now the three smart money indicators are back on the negative side because we're getting a mixed picture with accumulation distribution, where the chicken money flow and oscillator are negative. And the NYSE McClellan oscillator, even though it improved, it's still negative and the summation index is still going down. The Swindlen trading oscillator is now back to negative, as is the momentum for the NASDAQ 100. And we're still dealing with a Zohorchak method sell signal, but it's at a -6 where it improved from a -10, but it's still a sell signal, but less of one. Then the positive side, we're still looking okay, but seeing some weakness with our growth to value ratios. We actually saw a bit of an improvement with discretionary to staples when we look at that ratio. And now the S&P McClellan oscillator, it went back above zero, so the summation index is starting to turn up. And the parabolic SAR is positive. And we're seeing a bit of a mixed picture, but now some weakness is starting to come in with our momentum oscillators. And the bullish percent index, though, we're positive. The S&P, it went up. NASDAQ went up. Crossed back above 50. NYSE went up. Ease of movement, money flow, and ultimate oscillator. Some of these took a hit, but they're still above 50. The Vortex is positive, but it's been flatlining. And the financial sector doing good by itself, but still continuing to underperform the S&P, even though it bounced up a bit with that ratio on Tuesday. And then the longer term special K chart continues to be positive. And I don't show that because we only get maybe one signal a year on that one. So here are the pivot points. And because we had a wider day on Tuesday, we're going to get pretty wide here with our R1, R2, S1, S2 pivot points. And those are updated on the YouTube community tab as well as on the website. So our conclusion, still positive. We're asking the question. Now, it's clear that the market became more defensive on Tuesday. The reason there's a question mark here, is it going to continue? Because we saw it happen July 1st. Then there was a point a while back where we saw another more defensive looking day, but then it didn't really last. That's why we're watching this to see if more of that is happening. And we're still dealing with this overhead resistance. Now, that's not really a question mark. We just haven't been able to get above it at this point. So we are still positive in the short term, but there's really no conviction now that is remaining positive. Intermediate term, we're just flat out positive, seeing some weakness drifting in there, but we're also seeing some strength at the same time, and we continue to be positive in the longer term. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.